Strategy holds over 750,000 Bitcoin as of April 2026. That's 750,000. Not a fund, not an ETF. A publicly traded company, formerly called MicroStrategy, that has engineered a capital structure with no precedent in financial history. The mechanism is called a flywheel, and it only works because of one thing Bitcoin cannot do: inflate. Start with the basic loop. Strategy raises capital through equity offerings, through convertible notes, through preferred stock instruments like STRK and the newly issued STRC, nicknamed Stretch. That capital buys Bitcoin. Bitcoin appreciates. The stock appreciates with it. Appreciation allows Strategy to raise more capital at better terms, which buys more Bitcoin. The loop closes and restarts at a higher level. This is not leverage in the traditional sense. It is a compounding acquisition engine disguised as a balance sheet. The premium matters, and most people get it wrong. MSTR, Strategy's common stock, trades at a significant premium to its net asset value. If you divided the company's Bitcoin holdings by shares outstanding, you'd get a NAV. MSTR trades above that. The conventional read is that this is irrational, that you're overpaying for Bitcoin exposure you could get more cheaply elsewhere. The actual read is different. Institutions with mandates that prohibit direct Bitcoin custody, pension funds, insurance companies, certain asset managers, can access leveraged Bitcoin exposure through a regulated public equity. MSTR is not overpriced. It is a different instrument entirely. The premium is the price of access. STRK and STRC sit in a different part of the capital stack. STRK pays a fixed 8% annual dividend. STRC, branded Stretch, pays a variable monthly dividend, adjusted to keep the share price anchored near its $100 par value. Both give investors Bitcoin-correlated upside with a layer of structural priority over common shareholders. Strategy issues these instruments at favorable terms precisely because the market trusts the underlying asset. The preferred instruments feed the flywheel from the bottom. They are not alternative bets, they are fuel. Every dollar raised through STRC that buys Bitcoin tightens the scarcity of an asset with a hard cap of 21 million coins. Demand goes up. Supply cannot respond. The value of every Bitcoin already held by Strategy increases, which strengthens the NAV, which supports higher equity valuations, which enables the next capital raise. The mechanism is self-reinforcing by design. Nothing like this has existed before. That sentence is worth sitting with. Corporate treasuries have held gold. Companies have issued convertible debt. Firms have used leverage to acquire appreciating assets. But the flywheel Strategy has built depends on a specific property that no prior asset could provide: mathematically enforced, immutable scarcity at a global scale. Gold's supply responds to price. Higher prices incentivize more mining. Real estate can be developed. Equities can be diluted. Every traditional store of value has an elasticity mechanism. When demand rises, more supply eventually emerges to meet it. Bitcoin has no such mechanism. The 21 million cap is not a policy, it is a protocol. No board, no government, no central bank can authorize more. When Strategy buys 750,000 Bitcoin and holds them, those coins are functionally removed from accessible supply. The flywheel does not just benefit Strategy, it tightens the global supply picture for every holder. This is the part that has no historical comparison. Every previous corporate capital structure was built on assets that could be manufactured in response to demand. The flywheel is not just self-reinforcing, it is architecturally immune to the dilution that kills every other compounding strategy. Saylor has said repeatedly that Strategy is not a Bitcoin company, it is a Bitcoin bank. The distinction is precise. A company holds Bitcoin as an asset. A bank intermediates between capital markets and an asset, transforming the terms on which different classes of investors can access it. Strategy issues instruments, common equity, preferred equity, convertible notes, that give different investors different exposures to the same underlying asset. That is banking. And the asset at its center is one that no competing institution can manufacture. If this flywheel operates at scale for another decade, the implications extend well beyond Strategy's balance sheet. Other companies are already watching. Some are replicating. The model of raising capital in fiat, converting it to Bitcoin, and allowing the appreciation of a supply-capped asset to fund further capital raises. That model is exportable. It does not require MicroStrategy's size or Michael Saylor's particular conviction. It only requires that Bitcoin's supply remain fixed, which it will. The flywheel is not a bet on a company. It is a bet on the most important property in monetary history. That for the first time, an asset exists whose supply cannot be expanded by any human decision, at any price, under any political pressure. Strategy built a capital machine on top of that property, and the machine works precisely because the property is real. If this episode made you think differently, subscribe. New episodes every week. And if you want to go deeper, there's more waiting for you. This is not a channel about price, it's a channel about civilization.